Yes, guys and girls, welcome back to another BMO video. It is Friday, the 11th of July. Now, one thing to note is we are obviously heading in towards sort of the summer month, shall we say, end of this month and also next month as well. So markets may die down a little bit, as you may have noticed. Every summer, it tends to sort of quiet down, mainly because, again, people go on holiday, they've got lives to live, really. So yeah, expect sort of lower volatility, shall we say, or lower volume than you would normally expect. So firstly, let's quickly have a little look as to what we've had since Tuesday. We've basically seen price action that we were already looking at, like a bit more dollar strength, pound, a little bit of pound weakness, AUD a little bit stronger as well. So this is all well and good to see. But let's quickly have a little look at the calendar. So this one over here. And as you can see, if I just go on to since Tuesday, obviously we covered all of this. Wednesday, what we saw was CPI, 0.1%, was expected to go negative for the year over year. So that's somewhat of an okay sign. PPI, though, was pretty negative there. AUD and NZD, they did hold rates, and it was pretty much, they essentially said mostly what the markets were expecting. If you look at the reaction function, if you're unsure what that is, essentially, I have made a video on it, but basically the reaction function is how does the markets react to the event? So how does it react to like a Fed event or like an NFP or a CPI or just any sort of data? If we see pretty much no movement there, you would expect that what was mentioned or what was shown in the data was already anticipated. And that's what we saw. Saw a little bit of wiki price action, and then it pretty much just went back to what price action was doing prior to the event. Bailey then did speak at 11 o'clock. I didn't see anything that was mentioned on that, to be honest with you. FOMC minutes as well. We'll have a little look at that in a bit more detail. And next, obviously, when we speak in the dollar. Unemployment claims yesterday did come in okay. Obviously, lower the number, the better. But it's basically in the norm of data, as it has been for quite a while now. While I did speak, I was just having a little look at Bloomberg, and I didn't see too much on that regard, but I'll have a little look again and see if I can find anything. And then today, what we had was GDP. And if we just quickly from the UK, and if we quickly, I think it's done that thing again, hasn't it? Yes, save it, countries. And what we saw was the 3-month average coming a little bit higher than what the consensus was, but notice that month over month print going into sort of negative. It was expected to go into positive from negative 0.3, so that's not too good of a sign. We did see a bit of pound weakness. Then I am recording this just after 1:30, so as you can see, the employment data from Canada, very, very, very good. 83K is huge, especially coming from 8.8, it was expected to just stay positive. And the unemployment rate, 6.9% from basically 7, was expected to rise. If you look at the CAD, if you just look at GCAD, for example, you can see all of that strength coming through at this sort of 1 o'clock candle. EuroCAD as well, more strength. CAD yen, though, look at that, boom, still pushing. So pretty good for Canada. Not many people expected that, as shown in the reaction function. So yeah, apart from that, in terms of technicals, but again, we've just had a bit more stronger dollar since Tuesday. But remember, this is largely seen as the pullback to go lower again. Euro dollar as well. We are not too far away from 116, basically 90 pips away. GU, we're seeing more pullbacks. Dollar yen, we're seeing a bit more moves into our supply zone. And gold, we are seeing stronger price action now. So yeah, with gold not getting many pullbacks, but overall still looking for relatively okay strength there. But yeah, apart from that, that is myself on the news and the technicals. Pretty much the price actions continued as was largely expected. Bit of dollar strength, a bit of AUD strength, a bit of pound weakness, etc. Yen not seeing too much strength at the moment. So overall, just continue to go, and we are approaching some interesting demand and supply zones now. So we'll have a little look at that. So it's definitely something for us to monitor for next week. So that's myself on the news. Let's jump straight through onto the US dollar. So the US dollar. Now, as you know, this week, we didn't have too much data. All we had was really yesterday's meeting minutes. And if we quickly have a little look at the meeting minutes, that will give us a good, let me just quickly get up the Fed minutes. Let's quickly have a little look as to what was basically suggested there. But if I quickly show you this article from CNBC, and then we'll have a little look as to what some other people are saying about the dollar. But largely nothing's changed too much in terms of the thought process. Again, people are still losing confidence. This is all just driving that dollar lower. It's kind of what was what was expected anyway for the last few weeks. People are just still jumping on board that train. So let's quickly have a little look at this CNBC article. So Fed officials diverged at their June meeting about how aggressively they would be willing to cut interest rates, split between concerns over tariff-fueled inflation and signs of labor market weakness and economic strength. Now, you may have seen some news about some people are expecting the inflation print that comes out next week to start to show the tariff-related inflation. If that is the case, it will be interesting to see how, I want to see how the dollar reacts to that actually. Do we react pretty strongly to that? Because maybe the Fed doesn't need to cut by more, because as you know, if inflation is high or is rising, the central bank will be less inclined to cut. Or do we see, a bit of dollar weakness? It will be interesting to see how how the markets actually react to that. Now, the summary also showed a growing divergence over policy should proceed, and most participants assessed that some reduction in the target range for the Fed funds rate this year would likely be appropriate, temporary and modest, whilst economic growth and hiring could weaken. So how far could cuts go? Opinions range from a couple officials who said next cut could come as soon as this month to some who thought no reductions this year would be appropriate. Though the minutes do not mention names, Governors Bowman and Waller have gone on record saying they could see their way to cutting rates as soon as July at the July 29th to 30th meeting if inflation stays under control. So if that is the case, essentially how you would interpret that is next week's CPI. So Waller and what's her name? Sorry, I'm just delete LinkedIn. Waller and Bowman. So Michelle Bowman and Waller, if they both suggest that if inflation stays in control, they could cut rates, or they see themselves cutting or wanted to cut at the July meeting. So how do you interpret that? Well, simply next week's CPI on Tuesday, if that stays strong or it rises, then you would expect Bowman and Waller to potentially not want to cut. That could be supportive for the dollar initially. So let's see how we react to Tuesday. It will be pretty big event. In addition to that, do we have anything else we need to look at on here? But the minutes largely reflect the stance of policy is currently well positioned. So basically what was already known. Officials also noted that might face difficult trade-offs if elevated inflation proved to be more persistent, while the outlook for employment weakened. Since the meeting, Trump has continued to negotiate with key trading partners on tariffs. Trump initially announced on the 2nd of April, but then altered deadlines, obviously, as you know, pushbacks on the dates, basically. Many participants noted the eventual effects of tariffs on inflation could be more limited if trade deals are reached soon. If that's the case, trade deals are reached, inflation may stay under control and the Fed could continue to cut rates. So let's see if that does come into fruition. Now, ING says that all eyes are on inflation next week. And overnight, Trump has threatened a 35% tariff on selected Canadian goods starting 1st of August and floated the idea of blanket tariffs of 15 to 20% on most of US trading partners, up from the 10% baseline. If the letter to the Prime Minister, Mark Carney, Trump cited unsustainable trade deficits driven by Canada's tariffs and non-tariff barriers. So just still trying to basically increase the heat for that. Now, this puts even more emphasis on inflation data. Consensus centered around 0.3%, which would push the year-over-year slightly higher to 2.9%. If it weren't for the explicit dovishness from Waller and Michelle Bowman and Trump's persistent pressure on the Fed, a print like that would probably be enough to rule out a September cut. As things stand, it may take a 0.4% print for markets to fully price that out. So if that's, like I said, if we do see a pretty strong inflation print, could see a little bit of stronger dollar. But like I said, that is initially what should happen on paper, but we'll just have to see how the markets do interpret it. Now, tariffs too continue to touch the dollar only marginally, and our view remains that unless the US targets its biggest partners, China, EU, Mexico, and Canada, with new tariffs, the dollar is likely to look through this round of protectionism with the FX fallout limited to local impacts. Obviously, elsewhere, we have this data, which as you saw today, we saw that pretty well. Very, very good for Canada. And the price actions definitely suggested it. Now, in terms of Credit Agricole, let's have a little look as to what they suggest for the US, which is over here. And now they say, let me just do this. I don't know why that doesn't bring that to default settings, but it is what it is. And the broad dollar downtrend has stalled of late. And this may reflect a shift in the way investors perceive the US economy and its assets market. In particular, we note that the latest USD consolidation takes place against the backdrop of very resilient US stocks and lofty treasury yields, as well as evidence that the US is inching closer towards deals with several of its trading partners in a boost to its economic and fiscal outlook. We therefore think that the US fiscal stimulus voted into law last week could help offset some of the trade tariffs' negative impact on consumers. So we'll have to see if that does come into fruition, but logically, it should offset it slightly. Now, they're going to talk about the threat of further escalation. And we also note that more recently, US equities have outperformed other G10 stock markets in USD terms for the first time since Liberation Day. And if sustained, this can become an important FX driver, given the investors' expectation of growing portfolio rebalancing out of the US. So what that basically means is, if sustained, this can become an important FX driver. So they're talking about how well the US stock market has done. Well, we know markets have moved out of the US, right? So people have moved their money out of the US and into European or any other stock markets, right? If that's the case, and markets are seeing that actually the US stock market is doing very, very well in comparison to these other stock markets, then they're going to move their money back into the US to gain that. And that's only going to pump USD or strengthen USD as the demand increases, and of course, increase the stock market as well. That's what they're saying. And if that is the case, then we could see a bit of a stronger dollar. And that's what they're saying, is just monitor that. And it's something for you to consider. How do I delete this? Delete. There we go. Now, portfolio rebalancing, the demand for short USD hedges have become key components. For the USD to recover in earnest, it would take more hawkish Fed speak, as well as upside surprises in the US consumer confidence, CPI, and retail sales next week. The CPI data in particular could attract considerable attention, given the divergence views on the FOMC. In particular, evidence that price pressures have intensified further could lend support to the view that the Fed will be in no hurry to cut rates and in a boost support the USD. And that's what we're saying about next week's inflation will be pretty important, because what Waller and Bowman mentioned on the, mentioning in their sort of previous meetings about if inflation stays in check, i.e. it doesn't rise, then we could see a July cut. But if we don't see that and we actually see inflation rise next week, then you basically would anticipate Bowman and Waller to not want to cut, and that should allow the dollar to strengthen as markets decrease the probability of rate cuts. So if I just get up this, then we'll have a little look at that. So for July, you can see markets do anticipate pretty much a no cut anyway. For September, they do anticipate a rate cut. So if we see inflation stay in check next week, you would anticipate this to drop based on the comments of Bowman and Waller. This will obviously increase the amount of cuts, and this could also increase the amount of rate cuts as well for September. However, if we see it rise, then obviously this would basically stay the same, but this in particular would decrease. So this is the rate cut expectation, because we're at 4.5% for the US. This is 4.25%. This then would rise pretty much to around, this would decrease, this would rise pretty much the same level. And then that should allow the dollar to strengthen. Let's see how the dollar does react to that though. So yeah, apart from that, that's myself on the dollar. Relatively simple this week. I mean, it's essentially kind of just followed the pullback scenario. Doesn't seem like there's much negatives for the USD for this week. Something could develop next week for a negative, i.e. CPI stays in check or deals fall through, for example. But for now, it should allow, as we spoke about on Tuesday, the dollar to strengthen a bit more this potentially next week as well. So with that in mind, we could see dollar CAD come back towards 37,500, possibly a little bit higher than that as that pullback opportunity. Obviously, dollar CAD is sold off today because of Canadian growth. We'll have a little look at that later. But overall, we could just see that dollar just chop a little bit higher, similar to this price action where we just chop, but we do go higher. Chop, 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 possibly to around this level, maybe a little bit higher towards sort of this level up here. And then we'll see how we'll react next week to next week's data. Dollar Swiss, you may be able to capture some tactical upside. As we spoke about on Tuesday, this is basically the only supply zone I'm looking at. So if you want to capture some tactical upside, you're more than welcome to do that. It's completely up to you, of course. You can capture, about 100 pips or so to the upside. And then we'll see how we react around this supply zone, and then we'll go from there. But CNH, I'm not looking at. Dollar yen, I was, and I am still looking at. We entered the supply zone. What I noticed was a breaker structure. We saw some breaker structures here. We initially saw a supply zone get tapped into, and then we continue to rally up, which is a little bit annoying, and it is what it is. However, if we go on the basis that the dollar may strengthen a little bit more next week, we may just continue to push above this supply zone. So there's two scenarios we do monitor, which is number one, either inflation stays in check, dollar weakens off, perfect, or inflation comes in a little bit hotter, markets reduce the probability of a rate cut for September, and the dollar continues to strengthen. And if that's the case, then you go on the high time frame, you think, okay, where could we come into? Probably back into 4,800. So 4,800 could be the level. Oh, 47, geez. 4,800. And then we can just see where we react from there, really. So yeah, overall, I was a little bit disappointed with this price action here, but it is what it is. So we come up a little bit higher, 4,800, and then we'll see from there. It's an okay level, probably more recent level. A better level would probably be around 52, but obviously I don't think we'll get to there. So 50 would probably be the next level above 48. If we break above 48, you'd probably think, okay, the next level would be then 50, 150 on dollar yen. So let's see for, this is basically a next week sort of price action to monitor, really. So overall, the summary on the dollar is as follows. It's pretty much the same as Tuesday. The pullbacks should continue to happen. There's not much negatives happening for the USD for this week. Obviously, the overall theme is still there for a bit of dollar weakness. That's perfect. But we're just thinking a bit more near term now. And if we see CPI next Tuesday coming a little bit stronger, then you'd expect Waller and Bowman, when they speak next, to be a little bit more hawkish. And that should allow the dollar to strengthen. Let's see how we play next week. Literally, pretty much, it all boils down to CPI next Tuesday. So let's see. So that's myself on the dollar. Let's move straight on to the So the pound. Now, in regards to the pound, as you know, pretty much all that was expected this week was just GDP. That's essentially what everyone was waiting for. So it should be relatively quick on the pound today. We're just going to look at two articles, and then we'll look at a document, and then we'll have a little look at some technicals. So firstly, let's start off with this Bloomberg article, and this is what they say. Now, they say the pound heads for the worst run since November on UK growth concerns. Now, sterling traded 0.4% lower since June 24, taking the shine off the strong rally in 25, while part of the decline reflects a broader dollar rebound in recent days. Data on Friday showing the UK economy contracted for the second month has added momentum to the move. And what does this then mean? Well, essentially, what you have to think about is it just adds to the pressure of what was the government suggesting, right? There, as you know, there's a lot of government pressure, a lot of physical concerns. And this just adds to that concern. And it just gives that market the view that actually this is not going to do too well for the government. They're going to have to find some sort of way to bring this back. And as you know, if people start to see that there's concerns around, what could happen with the government, then people will move their money out of the pound or out of the UK and into other assets, maybe like the US or maybe like Europe, for example. That's why if you potentially look at Euro GBP, we're seeing that continue to rally up, right? It's just that, remember, as a trader or an FX, all you're doing is just following the flow of money. So if you know the flow of money should move out of the UK in the near term because of concerns, then you want to be staying bearish the pound in the near term until those concerns, go away, or we see positive things in the UK for once, for example. This is just some things to monitor. Now, while next week's CPI level market data could be more important for the outcome of the policy meeting, FX investors may have the patience before selling the beleaguered pound. So basically, just wait for next week's data before you say, actually, yeah, we probably want to be bearish the pound over the near term. The UK economy shrank 0.1% in May, as we saw on the data. Bets on the BOE cuts remained intact after the growth data. Money markets are pricing around 50 basis points of easing by year end and are still leaning toward a reduction in next meeting in August. That is negative for the pound after the slow pace of easing. And the sluggish UK GDP labor market slack emerging, and the likelihood of higher taxes could force the BOE to cut the policy rate more aggressively than anticipated, wrote Elias Haddad, a senior strategist at Brown Brothers Harriman. Now, ING also speaks about the GDP, and they say, sorry, where was I? May's decline looks more like noise than a signal, but there are growing concerns about the UK economy driven by weakness in the jobs market. And if next week's Thursday's payroll figures are bad, then it would pile the pressure on the Bank of England to speed up rate cuts. So that could be a thing for us to definitely monitor. Let me double check when that data is. It's normally in the morning. GBP CPI is on Wednesday morning. And then retail's data in the UK is normally, where's the UK CPI? Let me just double check. Wrong one. Let me just filter quickly to just the pound. So CPI on Wednesday, and then Thursday at, I don't know why that's medium impact, orange folder. It should be red. But average earnings, wages, obviously claiming counts, the amount of people claim for benefits. You obviously want that number lower. And of course, the unemployment rate. So what ING is mentioning is if this just continues to stress, the growth concerns that GDP has also suggested, then you would anticipate the BOE to potentially cut by a bit more. Next week, do we have anything after that? Or the week after next? Just PMI data and then Friday retail sales. So if next week's data does suggest issues, then that will definitely just reinforce more pound weakness over the near term, especially like GA over the near term as well. GA could also fall further. Euro GBP as well could also fall further as well. Bank of England opted to look through the first quarter strength, commenting instead that activity was probably more or less flat. We suspect it will reach the same conclusion for the second quarter, where overall quarterly GDP is on track for 0.1%. For the bank, it would likely force a rethink of pace of cuts. So that's if we see more weakness in the data. And in part, that is because the BOE assesses employment growth is virtually flat. And the latest data suggests that that's an increasingly optimistic view on the jobs market. So for now, our base case is that the Bank of England cuts in August and November, but the risks are clearly tilted towards more frequent rate cuts before year end. And if that is the case, but basically, the question you have to ask yourself is, how do you anticipate more rate cuts? Or what data would suggest that? Well, essentially the data we've seen today, a bit of GDP. So people are, oh, okay, this could potentially mean more rate cuts. But as we saw, people didn't really price in too much because they want a bit more data. But then if we see CPI next week come in lower and claimant counts suggest weakness, then people will then start to jump on board, because now it's starting to form through other avenues of data as well. So it's not just coming through GDP, but it's also coming through like claimant counts, and inflation is starting to show that there's less demand. And well, as you know, if there's a lot of demand for goods, inflation rises. If there's less demand for goods, inflation tends to fall. So with that in mind, obviously, we should still continue to see a bit of pound weakness, to be honest with you. Credit Agricole just basically suggested that there's more loss of confidence. And they say a confirmation of these expectations could add conviction to the market's dovish view and keep the pound on the defensive. That being said, we also know that negatives are already in the price and the GBP is looking undervalued versus the Euro, not versus the USD. I don't agree with that. I think the GBP can go a little bit higher. So let's see. What they're basically saying is Euro GBP has moved quite substantially higher, which could indicate a selling, but there has to be a reason for selling, remember. It's not like markets will look at an overvalued currency in the near term. Like Euro GBP is a good example where we've not had any pullback, really, very shallow, and it's moved so aggressively. But there has to be a reason for that. There has to be a reason for people to think, actually, now I want to exit the trades and start to get in short. So if there's no reason, then they're going to continue to buy Euro GBP, even though technically it is overvalued, which I know people may want to look at RSI, for example, as an indicator of overvaluation. which technically it is pretty overbought, as you know. And you can see COT data as well is relatively overbought as well. But it doesn't mean you now need to start selling the pound. It just means once there's a reason, to buy the pound, once there's a reason to buy the pound, especially against the euro, you would want to sell Euro GBP, but we know there's not a reason for that. Now, GA, we saw a nice amount of weakness. This is from the supply zone that we spoke about on Tuesday, which is the 2-hour supply zone here, and a nice amount of weakness there. Don't know how many pips there is. Let's just go from the open. Oh, wrong one. The open to where we are. 310 pips or so. Pretty decent. I'd be happy with that. And I don't know where we can pull back to next, to be honest with you. I mean, we could just drill down the time frames. 8-hour, it may have to be a shallow pullback toward back into this 206 handle, 2.06, and then a sell-off into basically into these lows. That would essentially be the only region I'm watching. Into here and then into here. I believe there's also a supply zone there. Yeah, an 8-hour supply zone also lines up with prior lows. It's a relatively okay level. So yeah, that would literally be the only region. There's nothing up here for me to monitor. So that's the only region I'm watching. GCAD, obviously GCAD, we were expecting a little bit of weakness on the basis of the pound, of course. And if we do see the further stress of the pound, then this demand zone or this zone that we were looking at, which is simply just prior lows that we've rejected from, we may actually go lower. So as we come into that level, I may have not as much confidence to buy GCAD as we get into that region, to be honest with you, because again, next week's data could suggest weakness. However, if we go opposite and we actually do see pretty good data, then this will be a good buying opportunity. We'll see that good data comes out, it spikes the trade. We just get in a demand zone and we try and hold it. You could do some shorter term TPs like that, for example. Pound Swissy, as you know, I'm not really interested in Pound Swissy. GJ, again, this is largely just because of the yen weakness, not pound strength. But as you know, it's not a trade for me at the moment until we start to see pound or yen strength. It seems as if even though we've had weaker GDP data, we've not really moved by much. And that's also because the yen is also pretty weak. I mean, as you know, it's pretty much the same as GA. So if you're bearish GA, you're also probably going to be bearish GN. So 8-hour, simply just there. Obviously that would be the ideal scenario for us to come into. But as you know, I don't think we will, based on what we know with the pound at the moment. And GU, lastly, the only region I will be watching for potential buying, i.e. dollar weakness, would be 134, because there's no other regions above there for me to monitor. We do have this daily there, but again, it's not exactly the greatest. So I'm just working with whole numbers here, where 134, big move rejection there, rejections here. If you look to your left, also there's a big high time frame level there. So you could suggest that 134 is going to be a level where people will probably want to be buying from. And if pressure is still mount on the pound, then obviously 134 will probably get breached through, and then we'll trade lower than that. So you can absolutely, if you want to, tactically sell it off into this region, monitor next week's data. If it comes in really positive, then obviously that's a reason to exit. But if it comes in pretty negative, then that's a good reason for you to hold on to it. So that's essentially how that's how you interpret it. So that's myself on the pound. To summarize, pretty quick this week. Essentially, it was just GDP data that we was monitoring. It didn't exactly show us amazing data. However, if next week's data does also suggest weakness, then the pound will probably continue to sell off more as people just move their money out of the UK because of stress. If we see the opposite, because the pound or the UK loves to surprise people, we see the opposite where claiming count is pretty good or wages is also pretty sticky, then that's a reason to sort of go against that GDP data and think actually the data is relatively resilient still. Also CPI as well, sorry, forgot to mention. So with that in mind, let's move straight on to the euro. Okay, So the euro, in regards to the euro, data-wise this week, as you know, didn't really have anything. It's pretty quiet, actually. So the euro has largely just been following pretty much what other people has been doing. So, for example, pound weakness this week was euro GBP upside, or AUD strength was euro AUD downside. So that's pretty much what we've been seeing this week. And next week, let me quickly share my screen. I don't think we have too much, if I remember correctly. Might be wrong though, but let me just double check. Euro next week. Do we have anything of interest? Not really, just German ZEW, and then finalized inflation data, which, as you know, generally will come out at consensus or around consensus anyway. So in that regard, I haven't got too much else to add on to that. I mean, we're only just going to look at this today, and that's probably pretty much about it. I mean, let me just double check Credit Agricole, but I'm pretty sure. Yeah, they're just still talking about pretty much what ING has mentioned about just follow like the trade talks and the tariffs, etc. So let's just have a little look. So there is no news on the EU trade proposal to the US, but in our view, the trade deal is unlikely to have a significant directional impact on eurodollar, which remains primarily tied to the Fed and US data dynamics. However, in the absence of major data releases, markets may make some short-term adjustments should details of a draft deal emerge already today. On the ECB front, the communication has been quiet, particularly on the topic of euro strength, despite it featuring heavily in the Sintra discussions. Interestingly, French Prime Minister Francois Bayrou called on the ECB to provide more support via looser policy. While this is unlikely to sway the governing council directly, it might highlight growing unease among European leaders about the risks of keeping rates on hold for too long, especially with a strong euro weighing on exports, because as you know, the currency is too strong, which has moved quite a lot in quite a quick amount of time. It can impact people's or companies' earnings or exporters' earnings, because too strong of a currency could allow less demand because it's just a bit too expensive for other people to buy from them. Euro USD dipped below 116.70, and while the near-term risk is more balanced, anything slightly skewed to the downside. The lack of fresh data suggests the pair may be anchored around 117 for now, which we're at 116.8. And again, a downside is mainly 116, as you know. Elsewhere, obviously the UK data, we've already looked at that. I mean, I can quickly show you Credit Agricole, but they pretty much said the same thing. And what they say is German ZEW. We'll also hear from ECB's Villeroy and the euro remains the most overbought currency. Obviously, it has been for quite a while and could remain vulnerable to bouts of profit taking on the back of potential data disappointments or more dovish ECB commentary. So that's actually that kind of relates to what I was mentioning about, what was it? The profit taking scenario that I just spoke about not too long ago, about how a currency can remain overbought for quite a while unless there's a reason to take profit, which at the moment there's not too much reasons, hence why the downside is largely capped to 116. And then, I mean, in that scenario that Credit Agricole was mentioning, if there is data disappointments or the Fed, the ECB speaks are pretty dovish, then that could allow more profit taking. But for now, since there hasn't been, you can't really suggest that Eurodollar could trade below 116, for example. Now, but yeah, apart from that, in terms of technicals, Euro AUD. Now, we were looking initially at this one, but what did we not see? We didn't see any structure to tell us we need to buy, so we leave it alone. As a result, we came a little bit lower. We're back into this demand zone on the 4-hour. It also lines up with prior highs. And is there a specific number it came into, though? 117.250 could have been that. But overall, it doesn't seem, the bearishness was quite aggressive. So what I want to see is some nice bullish price action form, for example, this, and then I'll get in on the demand pullback, right? But for now, I'm not going to just be looking to buy it just because we're seeing some rejections, purely because of how bearish this has been for quite a quick amount of time. It's just not something I want to be trying to trade against, right? We need to wait for structure to form, but there hasn't just yet. EuroCAD, largely consolidating. I mean, ideally, I'd like a bit of a pullback, but it doesn't seem like the pullback is happening. Like I spoke about on Tuesday, literally the only pullbacks I could see is just into these highs, and then that's about it. Euro GBP, obviously we're still bullish. There's no real reason for us to not be bullish it. So yeah, for now, I'm still looking for buys unless something significantly happens next week. Like, for example, the UK data next week could be really, really good. And that could allow Euro GBP to come lower, for example. But if that doesn't, then Euro GBP will stay largely to the upside. And then all we'll just essentially do is just look for the first high here and then the next high up there. Euro yen, as you know, I mean, it's a bit difficult to sort of sell this pair. There is literally no bearish technicals here. So there's no point in trying to sell it. it still makes sense for upside, just given the yen weakness and, of course, euro strength. Euro New Zealand is actually, we saw a nice reaction from this demand zone that we looked at, which was the 12-hour. Very nice reaction, actually. I did not realize it reacted so well. We're seeing some bullish price action start to form now. So definitely something for me to watch. This would have been probably your opportunity. This sort of 2-hour, if we can get a push into that, ideally that, obviously. That would be the only region I'll be watching really for a pullback and then a potential push. Euro dollar, as you know, there's no reason to buy it at the moment in terms of new reasons. So a new reason could pop up soon. It could pop up, 2 weeks from now. All we need to do is just wait for that reason to come through. And then that's when we'll start to get in. But 116 is literally the only level I will be watching for any sort of buying opportunity. So for now, I'll leave it alone, but 116 is my level. So yeah, apart from that, that is myself on the euro. Relatively quick today, just because nothing's really happened. Next week is probably going to be pretty much similar. Just follow what other people are doing. Pound data is going to impact Euro GBP, or Australian data, or US data, or ECB Fed speak. That's literally the only thing that you will be considering, is just what is other people doing rather than European data perspective. But apart from that, that's myself on the euro. Still, it does still make sense for buying. It's just that because there's not much new news, especially if you're looking against the dollar, it does make sense to buy it. Against others, like the pound or New Zealand, it makes a little bit of sense, but you just have to selectively choose what trade you want to be choosing. So that is myself on the euro. Let's move straight on to the AUD and the NZD. So the AUD and the NZD. As you know, with the AUD Australia this week, we had the RBA. We did speak about that on Tuesday, so please go back and watch that breakdown if you'd like to know what the RBA did. However, what we did then saw was, or what we did see was the RBNZ, literally the morning after the breakdown. So let's have a little look firstly at AUD. What I think I'm going to do actually is read through credit agriculture, because they actually have a very large segment on both currencies and it's relatively decent. So we'll have a quick little glance at that. And if there's any other things that we can talk about for the NZD, I will, but it was largely consensus thing. Nothing really happened that was of interest. Yeah, pretty much nothing really happened. So let me quickly share that then, actually. This one over here. Yeah, this one. Now, if we scroll down, you can see pretty large segment. But while Trump is ramping up tariff pressures, the AUD and the NZD are being kept on a gradual uptrend by the president keeping the doors open to negotiation, as the RBA and the RBNZ being hesitant rate cutters. Indeed, the RBA surprised this week by keeping rates on hold, but it was a dovish hold, with Bullock indicating the policy board was waiting for Q2 inflation release on the 30th of July to confirm inflation is falling. We spoke about that. Essentially, any inflation data from now is going to be very important for people, because they want to see actually if inflation does come in a bit lower, then that should allow the RBA, to cut by a bit more. Now, the RBA's on hold decision did bring market pricing for the RBA more into line. However, with the Australian rates markets pricing about 50 basis points more of cuts before year end, down from 75, this will remain an underlying support for the AUD going forward. Now, you can read through this in your own time, a bit more on the growth data, etc. And the RBNZ left this OCR unchanged. While it pointed to the likelihood of further cuts, there's a rising risk it could stop short of cutting rates to its forecast terminal of 2.9%. So basically, it's very, very close. As you can see, 3.25 to 2.9. And that's what they're suggesting, that, the neutral rate, or where they will want to basically stop cutting. The OCR is already close to neutral, and the New Zealand's economy does not need stimulatory rates. The economy is bouncing strongly out of recession on the back of earlier rate cuts, as well as strong commodity export prices and agricultural production. Inflation is also turning back higher and will move to top of the RBNZ's 1 to 3% target band in the coming quarters. The economy recovery and gradually rising inflation are surprising us to the upside. So too is the combination of weak oil prices and strong agricultural export, which is yielding a high terms of trade for the economy. In addition, there is a persistent weakness of USD. So we are revising up our New Zealand USD forecast to an average of 61 previously 60 and 63 by year end. So where we're at the moment, let me just double check. We're sat at 60 on the dot. So a decent amount of moves there, according to them, about 300 pips by year end. Now, in terms of international factors, obviously you can read through this. It's all about tariffs. Essentially, what you need to do with tariffs is just think, are there any sort of deals being made? If there are deals being made, then that should remain a relatively supportive thing for both economies. If there's not, or there's more threats, or there's more stress, that could be a downer on the currency. But for now, what we have seen is, like we know, Trump wanting to do some sort of deals. So if that does continue, that should be relatively supportive for both currencies, as you know, the hopes of a deal being made is there. Now, US inflation, obviously you need to focus on that because USD can also impact AUD and NZD, but our China economists look for mixed data in the coming weeks. She expects soft trade and retail sales data relative to market consensus, but upside surprises to GDP and industrial production data. We just have to see how it reacts to those bits of data, really. But yeah, overall, I wouldn't say that's the main driver of the currencies, though. And the main drivers of the currencies, as you know, RBA looking to hold off a little bit longer. So is the AUD and NZD. And in addition to that, there's some sort of deals being made, which should be relatively supportive for the currencies, barring there are no pushbacks on that. If there are pushbacks, then obviously it will be a downer on the currencies. Now, AUD CAD seems to be rallying further. Where can we get in, though? That's the issue for me. Doesn't seem like there's many opportunities. The first opportunity that I will be monitoring closely would be this high. The next ones would be basically down towards 89,200 to 89,300. And then that'll be about it, really, for AUD CAD. Obviously, AUD JPY still rallying. Doesn't seem like there's a reason to sell it just yet. AUD strength, yen weakness is a recipe for upside. AN, I mean, it seems as if markets are buying into Australia more than New Zealand. We can just follow that trend because market structure is starting to form to the upside. It is pretty bullish. This is the daily, this is the daily time frame, pretty bullish. Go down the time frames. There's not going to be many opportunities unless we see basically a bouncing towards these higher, 109 basically would be the level. AU, I would have ideally liked to see more downside before more upside. Doesn't seem like that's the case. However, what you do have to know is if this daily candle doesn't close above this high made here, then that could allow for some pullbacks. So just be cautious of that. New Zealand dollar CAD is in consolidation, so I'm going to largely leave that alone. New Zealand dollar yen, obviously a bit more upside. We are in a supply zone on the daily, but we know it doesn't seem like there's a reason to sell NZD JPY just yet, so we'll just leave that alone. And NZD USD, ideally the best buying opportunity, which could actually still happen because market structure could potentially suggest it, is essentially down into this 12-hour demand zone. We're not too far from it, but I am a little bit cautious, though, of this bullish structure that is starting to form. So if we don't continue to trade to the upside, then that demand zone is the only region I will be watching. The only region, how would you know markets are now going to turn to the upside after this break of structure? Just monitor how it reacts out of demand zones on the lower time frame. So for example, let's say this was a demand zone, which it isn't, but let's say it was. If we start to see structure, that would suggest that that is now going to start the next leg up. So let's see if we can. So far, it doesn't seem like it's reacting too much. It's still early days. It is Friday, obviously, so I'm going to leave it alone. Not going to read too much into it. But yeah, that's essentially how you would look at it. But yeah, apart from that, that's myself on both currencies. To summarize, it's pretty much the same for both, actually. Central banks are relatively remaining on hold. RBA said that they want to see how inflation is at the end of the month and then decide from there. How do you know if inflation stays sticky in Australia at the end of the month? That would allow markets to think that there aren't going to be many cuts in the future. Bullish factor for AUD. Similar for New Zealand. We're very close to what they class as their neutral rate. Basically, rates at which inflation is moving lower nicely, but it doesn't hurt the economy. Because as you know, high rates hurt an economy, right? Because it's expensive to borrow. Mortgages are expensive. Everything's pretty much expensive. So if inflation falls, it should be supportive for said economy because it's now cheaper, it's borrowing, and hopefully it should allow the economy to grow. So yeah, that's why both currencies are strong. And of course, the main one is trade deals. Trump seems to want to be doing deals. If that does continue, should be still a bullish factor. So that's essentially what you need to be monitoring. So that's myself on both currencies. Let's move straight on to the... So the Canadian dollar, just to let you know, I apologize in advance. I do have my aircon on at the moment. It is roasting. So if there's a little bit of background noise, I apologize. If not, perfect. But just thought I'd let you know just in case. Now, in terms of the CAD, I've only got basically one thing. I mean, we've had pretty much only the growth data today, which is the main event. And then apart from that, that's pretty much about it, really. So with that in mind, let's quickly have a little look at the growth data in Canada. It was actually really, really good, as you may have seen. So let me just quickly find that Bloomberg article. I literally found it not too long ago. I'm not sure why it's not finding it now. Give me 2 seconds. Okay, I'm just going to have to use somebody else then. So I'll just use Reuters. For some reason, the Bloomberg article is just not there now. So let me start off with the Reuters one. And as you can see, Canada's economy adds 83,000 new jobs in June. Now, the Canadian jobs report isn't quite as strong as it first appears, but it's certainly solid and will sideline the Bank of Canada for several months at a minimum. Given what's happened this year, the Canadian economy is performing better than almost anyone thought it would be. It's one of the least classic Canadian employment jobs reports in so far, as the details tell a slightly different story than what the headline numbers. But overall, 83,000 is just a lot of jobs in the context of a slowing population growth. Just looking at the data, it suggests that perhaps there is a little more resilience in the economy than we had anticipated. Manufacturing sector did add jobs in the month of June, but that comes on the heels of 4 consecutive months of job losses. You are going to see that some sort of inherent volatility in an environment where trade relationships are uncertain. Basically, there's always going to be chop and change in the growth data in that specific sector, in the manufacturing, obviously because of all of the tariff scenario. And Canada's labour market showed resilience in June, with employment jumping by 83K and the unemployment rate falling by a tick to 6.9%. While the unemployment rate is still elevated, the strength in other measures in this report clearly diminishes the odds of a Bank of Canada cut in July. So with that in mind, EuroCAD, we could see a little bit marginally stronger CAD. I mean, how's the yields reacted? A bit positive, of course, a bit on the positive side, which is nice to see. And as a result, you could see like EuroCAD hopefully come a little bit lower and then initially higher again. AUD CAD, hopefully a pullback and then a bit of a move higher again. But I'm not really seeing too much else on the employment report perspective. I don't know where the article's gone now. But yeah, overall, with the CAD, okay data, like they said. And Credit Agricole is also saying this about the Canadian dollar. And they said USD CAD has been able to bounce marginally off its sub 136 lows, thanks mainly to the tentative resurgence of USD across the board. Mid a light load of domestic macro releases, the recent news flow has overall proved a tad negative for the CAD, as the US administration has just announced a 50% tariff on copper imports to come into force. And PM Mark Carney has warned that the pledge to ramp up defense spending will most likely imply savings elsewhere due to fairly tight budget constraints. The CAD could ultimately face more critical tests in the coming week, starting with the June labor report today, which obviously it was pretty decent. On Tuesday, CPI for June, at least the core metrics in order to confirm the upside pressures have stalled, just like what the BOC expects. And barring any major surprises, USD CAD could continue to primarily follow the broad dollar trend, which would allow, obviously, USD CAD hopefully to go a little bit higher first before coming lower again. Because as you know, we would like to sell USD CAD and it could just come into our level around here and then hopefully a sell-off. Let's see how that performs. So yeah, overall, GDP data was relatively okay. But the question is, we have to ask ourselves mainly is this then going to change the overall theme in Canada? I wouldn't say so. I'd see this as more short-term volatility, mainly because if you look at it from the overall data, it should support the CAD downside trade because the overall data is still relatively weak on a larger scale. Like what, I can't remember, the guy on the Reuters article said, it is just because of how weak the data got for so long, it just creates more volatility where suddenly you may see a big spike and it looks a little bit out of proportion than it would normally be. So overall, that's myself in the CAD. I haven't got any technicals. Obviously, CAD JPY should continue to rally. That's fine. CAD Swissy, I don't trade. But we did actually react at 58, which is just a whole number. You got to remember, that's all-time low. So it's literally just a whole number. It's a bit difficult to trade, so I leave it alone. But overall, that's myself in the CAD. Relatively quick. To summarize, I would say, like, the data today was actually it was okay. It was good, but it doesn't really change the theme. Because to understand if it changes the theme for the economy is if it changes everything. I don't think it changes everything. I think, for me personally, you have to look at the totality of everything, and it's all still pretty glum and weak. So if that does continue, then CAD should stay weak further. Not against the dollar, obviously, because USD should take, front footing of that. But like, it should allow like Euro CAD to go back up again and AUD CAD to go up, maybe G CAD eventually, but that obviously has a little bit more downside. So it's just selectively choosing, I think. If you want to leave CAD alone, I would not be surprised if you want to do that. So that is myself on the Canadian dollar. Let's move straight on to the yen and the... So the yen and the Swiss. In regards to the yen, obviously this week we haven't really had any major data apart from Monday morning, 12:30 a.m. average cash earnings, which if I quickly show you, I did speak about this on Tuesday. But what we saw was the average cash earnings coming in at 1%. It was expected to rise quite a decent amount. But a 1% move is not exactly the most best and rosy of pictures. I think people still do like the fact, or they do still have some sort of faith that the inflationary picture in Japan is still there, which I suppose it is technically. But if this all just starts to really drive down inflation, then yes, you would not expect any BOJ hikes at all this year. Now, Credit Agricole does mention about that, and they do suggest something along the lines of, where was it? I saw it here. Japan's nationwide CPI is expected to follow the Tokyo data. It's only showing a modest deceleration in inflation and keeping pricing for another hike supported. So, yeah, we did see some initial weakness in the average cash earnings, which is wages, by the way. But again, that's kind of only one print. So like one print, right? The phrasing, I can't remember where it was, but it was like one print is like an eyebrows being raised. Two prints is a potential trend. Three prints is a trend. So, or like one print is a fluke. Two prints is something to watch. Three prints is a trend. So what that means is this print that we saw on Monday morning is it doesn't paint the roses pictures, but like the other bits of data out there is already doing pretty well. So it's like one bit of data is a fluke. It's like, it's just one bit of data. It doesn't really suggest anything. Yeah, but that's why sometimes you see, it's a good example, where you see a data print comes out, it creates volatility, like a bit of weakness or a bit of strength or just wiki price action. And then it goes back to what was originally happening with the currency. So if the data came in really, really strong, but then the overall fundamentals are still pretty weak, it creates strength in the currency in the shorter term, but then it initially goes back to weakness because like it might just not paint, it doesn't really change the narrative, if that makes sense. If other bits of data out there was weak and this wage data came in weak as well, then that would suggest that actually the trend is there. But because there isn't, it doesn't really suggest that trend, if that makes sense. Now, there is something for you to consider, which is the election, upper house election, which will be important for the yen. In our view, it is that a poor showing by the LDP Komeito incumbent government would lead to a more pressure for fiscal stimulus and a shift back towards Abenomics. This would also mean the government placing more pressure on the BOJ not to hike rates, so that could weigh in the yen. US retail sales inflation data as well as Japan inflation will also be important for the yen in the coming week, and the former will determine if the USD resurgence can continue. So the former meaning the inflation from the US and retail sales. And if that's the case, and we do start to see a bit of stronger dollar, obviously that can also weigh in the yen as well. So just note that accordingly, because again, the yen is very sensitive to shifts in the dollar. It's also shifts in the 10-year yield, which we are seeing a little bit of bullish price action. This is the weekly. So we go to the daily, you'll see we are starting to see some bullish price action this week. That has weighed on the yen as well this week as well. So if that's the case, and next week's inflation prints in the US is relatively strong, that could allow the yen to weaken off a little bit more. So just be a bit cautious of that. And that would allow dollar yen to go above sort of this supply zone that we were looking at. Now, in regards to the Swiss, I've not seen anything, to be honest with you, but I just want to double check this. Yeah, it doesn't really say anything. I'm just running Credit Agricole. They're just mentioning the FX reserves. And then they talk about the Swiss may still need to be enticed by more Swiss buying from reserve managers. Ultimately, the Swiss may still need global uncertainties related to trade and fiscal policies to reverse recent gains, while a light domestic calendar in the next week will not be of any help. So that's all they really have to say on it. So yeah, in regards to the yen and the Swiss, that's really it. It's pretty quick today, just because, again, nothing's really happened in that regard. The yen still has pressure from the tariffs. It's got pressure from potential, the upper house elections very soon. It's not really a recipe for yen strength at the moment. And of course, dollar strength. Dollar strength is not a recipe for yen strength either. So it doesn't seem like the time's right just to get in. Regards to the Swissy, it's actually holding relatively steady still. I think just because of uncertainty, trade uncertainty. That seems to be the only thing holding it up. So that is myself on both currencies. Let's move straight on to gold. So gold, let's quickly have a little look. So gold, as we spoke about, should hold relatively steady, to be honest with you. Uncertainty is still rife. And in an environment where there's uncertainty, does gold do very well in? So yeah, I mean, for gold, as we spoke about on Tuesday, we do have a demand zone there on the 4-hour, but also note there is a 12-hour demand zone. So let me just extend that box. If we can get a pullback into there, ideally, there is also another little demand zone there, so watch that closely. But yeah, any pullback we see is opportunity. A pullback into this demand zone, which is on the 12-hour, and then hopefully a push back up. You can target the first high there, second high there. But yeah, that's myself on gold. It's, again, all it's doing is just following trade uncertainty, because there is uncertainty at the moment. If that does continue, then gold should continue to rally. So that's myself on today's breakdown. Myself, Andrew, of course, see you next week. Take care, everybody.